Welcome to today's deep dive, where we are looking at real estate not as a place for you to live, but as a machine.
A machine specifically engineered to generate financial independence. We're looking at a completely different paradigm for property ownership today.
We really are. We're extracting what feels like a literal cheat code for rental property investing. And we're doing this by breaking down Brandon Turner's The Book on Rental Property Investing, specifically through the lens of the Swedish Investors Analysis.
Fantastic breakdown.
It is. And honestly, if you apply the strategies we're about to cover, it might just keep finance YouTubers like Graham Stephan awake at night.
I mean, probably.
But before we get completely lost in the hype, the sources are very clear about establishing some ground rules. We are not, and I repeat, not exploring some flashy get-rich-quick scheme here.
Oh, far from it.
Uh-oh.
Treating real estate as a passive overnight wealth generator is pretty much the fastest way to lose your capital.
Yeah, nobody wants that.
Right. The sources emphasize a highly systematic, often really gritty approach. You are essentially building a small business from the ground up.
Which is a lot of work.
It is, and that requires a very specific temperament.
But the allure is undeniably strong, though. I mean, the sources highlight some massive pros to jumping into this game, and the first one that jumps right off the page is leverage.
Leverage is huge.
Because in a traditional investment, like, say, buying a stock, you generally use your own money. You have $10,000, you buy $10,000 worth of shares. Simple.
Right, a 1-to-1 ratio.
But real estate operates like finding a glitch in a video game, where you actually get to play with someone else's tokens.
That's a great way to put it.
You don't need $300,000 in cash to buy a $300,000 property. You borrow the bank's money to get in early, control a massive asset, and amplify your returns.
And the mechanics of that leverage are incredibly powerful when the market is stable or growing.
How so?
Well, think about it. If you put down 20% on a property and the entire property's value goes up by 10%,
Okay.
your return on your actual cash invested is 50%.
Wow. That's wild when you do the math.
It is, but you have to be careful because leverage amplifies losses just as effectively as it amplifies gains. You're taking on debt to control that asset.
Right, which means you are on the hook for the payments regardless of what the market is doing.
Exactly. The bank wants their money on the first of the month, period.
Right. Well, and then there's the hustle factor, which I love. You can literally force better returns by rolling up your sleeves.
You really can.
Because you can't march into the headquarters of a major tech company and force their stock price up by, like, repainting their lobby.
No, security would definitely throw you out.
I would. But you can buy a duplex, rehab the kitchens yourself on the weekends, and instantly increase the value of your investment.
Which is incredibly empowering.
And plus, there is this fascinating point in the sources about insider trading.
Oh, yeah, the legal insider trading.
Right. Because in the stock market, if you trade on knowledge the public doesn't have, you go to federal prison.
Do not recommend.
Yeah, please don't do that. But in real estate, you are actively encouraged to find out that a neighborhood is getting, say, a new commercial center or a transit line before anyone else does, and just buy property there.
Because residential real estate is an inherently inefficient market.
What do you mean by inefficient?
Well, stocks are priced by millions of complex algorithms reacting in milliseconds. Right?
Yeah, it's all automated.
But a house on a random suburban street is priced by, well, a motivated seller maybe going through a divorce, or an emotional buyer looking for a specific school district,
Oh, I see.
or even a real estate agent who just wants to close the deal so they can go on vacation.
So humans being human.
Exactly. Information asymmetry is your greatest asset here. You can literally know more about a specific neighborhood than the person selling the property.
Which all sounds like an absolute dream scenario. And it leads directly into the pitch used by, every late-night real estate guru ever.
Yes. Passive income.
The dream of passive income. The idea that money just magically rolls into your bank account while you decide to stay in bed on a Tuesday morning.
If only it were that easy.
Right, because the sources provide a rather harsh reality check right after laying out those pros. They hit us with the reality of the tenants.
Yes. The human element.
They talk about dealing with people who have turned coming up with excuses for late payments into an absolute art form.
Or tenants who treat your property like a demolition derby.
Yeah. And if your tenants are actively inventing artistic excuses for why the rent is missing, doesn't that completely destroy the illusion of passive stay-in-bed income?
It absolutely does. The term passive income in the context of rental properties is, frankly, essentially a misnomer. especially in your first few years.
Just totally misleading.
Completely. If we connect this to the bigger picture, the barrier to entry in rental properties isn't just accumulating the capital for a down payment.
What is it then?
It's your personal tolerance for friction.
Tolerance for friction. I like that phrase. The sources explicitly warn that wealth building here requires consistent action over a very long period. It is the literal definition of get rich slow.
Yes, it is a marathon, not a sprint.
And frankly, reading through these materials, it sounds like an all-consuming obsession. You know, you're sitting at your desk working your normal 9-to-5 job, but your brain is thinking about the plumbing in your duplex.
Oh, you will definitely think about the plumbing.
You're walking the dog in the evening, and you're mentally calculating neighborhood yield rates. You might even find yourself arguing with your spouse about whether to patch or replace a cracked driveway. The mental tax seems incredibly heavy.
It is heavy. It invades your mental space because you are operating a customer-facing business.
Right.
It comes with all the liabilities, the late-night phone calls, and the difficult human interactions that literally any landlord faces.
Not to mention the paperwork. I mean, bookkeeping, tax forms, lease agreements, local compliance laws.
The administrative burden is huge.
Yeah, if you hate administrative work, you're either going to drown in receipts or you're going to have to sacrifice a significant portion of your monthly profits to hire a property manager.
Right, to handle all those headaches for you. And if you do not have the stomach for that administrative and emotional friction, that leverage we discussed earlier will eventually crush you.
Because the bank still wants their money.
Exactly. A vacant property or a destructive tenant can drain your savings rapidly when you still have a mortgage payment due on the first of the month.
Okay, so if you're listening to this and you haven't been totally scared off yet.
Which hopefully you haven't.
Right. If you actually have the stomach for the friction and the hustle, the obvious question is, how does all that sweat and stress actually translate into financial freedom? Like, how does a leaky roof make you wealthy?
It's all about the mechanics. The sources break down 4 distinct engines of wealth generation in real estate.
4 engines. Okay.
And understanding how these 4 engines operate simultaneously. That is the dividing line between an amateur who just buys a property and hopes for the best and a professional investor building a portfolio.
Okay, let's unpack this. Let's start with appreciation. This is the simplest one to grasp, right? Just the property increasing in value over time.
Correct.
And the sources divide this into 2 categories. Natural appreciation, which is just inflation, and local market scarcity pushing prices up over the decades.
And then forced appreciation.
Right, which is you going in, knocking down a wall, updating a bathroom, and actively making the place worth more.
Exactly.
But the sources mention this specific context in the Swedish housing market, where 30 years of nonstop natural appreciation created this massive countrywide FOMO.
Oh, the fear of missing out was intense there.
A total panic. Everyone was screaming, you know, buy now, pay whatever they're asking, or wait on the sidelines while everyone else gets rich.
And that specific type of market frenzy is incredibly dangerous for an investor.
I mean, I have to ask, if natural appreciation requires you to basically have a crystal ball to predict what the housing market will do in 5 or 10 years, isn't banking on your property's value going up basically just gambling disguised as investing?
That's a really sharp observation, and the answer is yes. Relying primarily on natural appreciation is entirely speculative.
So it's a trap.
It can be.
Yeah.
What's fascinating here is that you are hoping that macroeconomic forces, interest rates, and local demographic shifts all just magically work in your favor.
Right.
Professional investors do not base a business model on hope. Natural appreciation is treated as a bonus, not the foundation of the investment.
Which brings us to the other 3 engines, the ones you can actually control or calculate.
Yeah, the mechanical ones.
There's tax savings, which often gets glossed over but is massively important. The general principle here is that governments around the world actively incentivize private citizens to provide housing.
They need private housing.
Right. They want you to buy and maintain rental properties, so they offer aggressive tax benefits. And the biggest one mentioned is depreciation.
Depreciation is huge.
So even if your property is technically going up in value, the government allows you to deduct the perceived wear and tear of the building from your taxes every year.
It's a phantom expense, essentially.
Yeah, so you could be making money every month, but on paper, for tax purposes, you show a loss.
Exactly. Depreciation is an incredibly powerful tool for shielding your active income from taxation. But, you know, the third engine is perhaps the most mechanically reliable of them all.
Which is loan paydown.
Right.
And when you look at the mechanics of a conventional 30-year mortgage, there is absolute magic in the math here.
It's beautiful.
It sounds depressing at first, though, because in the early years of a mortgage, when you look at your statement, the vast majority of your monthly payment goes straight into the bank's pocket as interest.
Yeah, that first few years can be tough to look at.
You're sending them this massive check, and you're barely making a dent in the actual principal amount you owe on the house.
Because the amortization curve is heavily front-loaded with interest. But as the years progress, that ratio slowly and systematically shifts.
Right.
Without your monthly payment ever increasing, a larger and larger percentage of that money begins applying directly to the principal balance.
So you're paying off the actual house.
Exactly. By the final years of a 30-year loan, almost 100% of your payment is going toward building your equity in the property.
And the absolute beauty of a rental property is that you aren't the one making those payments.
No, you are not.
Your tenant is. Your tenant wakes up, commutes to work, puts in 8 hours a day, and hands over a portion of their paycheck to systematically pay off your debt.
It's incredible.
The tenant is literally building your wealth for you.
They are. That mechanism operates quietly in the background every single month. And this is a massive, but that mechanism relies entirely on the property being able to sustain itself.
What do you mean?
You cannot capture the benefits of loan paydown, tax savings, or long-term appreciation if you are bleeding cash every 30 days.
Which brings us to the true north of real estate investing. Here is where it gets really interesting. Cash flow.
Cash flow is everything. It is the only reliable pulse of a good investment.
Right.
It is the actual tangible money left in your bank account from the tenant's rent payment after every single expense, including the loan interest, taxes, and maintenance has been paid.
The actual profit.
Exactly. If a property does not generate positive cash flow, you have not purchased an asset. You have purchased a liability that will drain your personal reserves.
So cash flow is just a buzzword until you actually sit down and run the numbers. Because how do you know you aren't just buying a money pit?
You have to do the math.
Right. Calculating this isn't just looking at the monthly rent check, subtracting the mortgage, and smiling.
No, rigorous, unemotional accounting is mandatory here. You have to start by determining the actual income potential of the asset.
And you can't just guess what rent to charge based on your gut feeling.
Definitely not.
You have to determine the fair market rent. That means looking at the specific location, the number of bedrooms, the quality of the finishes, and the square footage.
Requires research.
A lot of it. You're cross-referencing local property management listings, you're digging through Craigslist, checking Airbnb rates for comparable spaces. You really have to get a concrete pulse on what the local market is actually willing to pay.
But honestly, income is the easy part.
Oh, yeah.
The expenses are where people get completely tripped up. The sources split expenses into two very different categories.
Operating expenses and capital expenditures.
Right. And the distinction between the two is where many novice investors fail. Operating expenses, or OPEX, are the predictable recurring costs of keeping the property functional.
So like the day-to-day stuff.
Exactly. It's the annual property taxes, the mortgage interest, the landlord insurance policy, and maybe utilities you might cover, like water and garbage collection.
Okay.
You can call the local county assessor and utility companies to get exact historical averages for these. They are mathematically knowable.
And then there are the capital expenditures, or CapEx. These are the monsters hiding in the closet.
That is a perfect way to describe them. CapEx represents the infrequent but massive gut-wrenching costs of property ownership.
The really scary stuff.
It is replacing a sagging roof. It is installing a completely new HVAC system when the old one dies in the middle of a heat wave.
Yeah.
It is gutting a bathroom because of long-term water damage.
They don't happen every month, but the sources stress that you have to carve out a piece of that rent check every single month and hide it in a reserve account.
You have to.
Because if you aren't calculating CapEx reserves, a single dead furnace will wipe out 3 years of your cash flow.
It absolutely will.
So let's run the math scenario provided in the sources to see how this actually works. Say you're looking at a $300,000 property. To secure a conventional investment loan, the bank requires 20% down. That means you are tying up $60,000 of your own hard-earned cash just to get the keys.
Right, so you deployed $60,000 in capital. Now you must measure the return on that specific capital.
So you do your research. The property brings in $1,500 a month in fair market rent. You subtract all the known operating expenses, and you subtract your monthly capital expenditure reserve.
Right.
Let's say your total expenses are $1,200 a month. That leaves you with $300 a month in pure cash flow. Multiply that by 12 months, and your property generates $3,600 a year in profit.
And the metric used to evaluate that performance is called cash-on-cash return on investment, or Q2CRI.
So you take that $3,600 in annual profit and divide it by the $60,000 in cash you put down. That yields a 6% return on your money.
Exactly, 6%.
Now, wait a minute. So what does this all mean? I can take that same $60,000, put it into a totally passive S&P 500 index fund in the stock market, and historically generate somewhere between 7 to 10% a year.
You absolutely can.
And in the stock market, that money just sits there growing. I don't get phone calls at 2 in the morning about a clogged toilet. I don't have to evict anyone.
Very true.
If my rental property is only giving me a 6% return for a $60,000 down payment, and I have to deal with leaky roofs and angry tenants, why on earth would I do this instead of just buying stocks and taking a nap?
That is fantastic pushback.
Yeah.
And it gets to the core of value investing. A 6% cash-on-cash return for property management friction is an unacceptable yield.
Okay, so it's bad.
If you are buying a turnkey property that looks beautiful in an online listing, you are paying retail price.
Yeah.
You are essentially buying the 6% scenario, and you will eventually burn out from the effort required to maintain it.
Wow. Okay.
The core tenet of value investing in real estate is that a standard retail deal is not good enough, which is exactly why a smart investor must actively hunt for a higher yield.
So the 6% example isn't the goal. It's actually a warning.
Precisely. To win at this business and outpace passive index funds, you have to actively hunt down deeply discounted, undervalued deals. You have to find the properties that the rest of the retail market is terrified to purchase.
There's a great quote in the sources: price is what you pay, value is what you get.
I love that quote.
But finding high value, like finding a house that is fundamentally sound but priced way below market, that requires a tremendous amount of sifting. And the sources introduced a fantastic rule of thumb for this exact process, the 100-10-1 rule.
This rule is essential. It reduces real estate acquisition to a pure numbers game.
So the rule dictates that you look at 100 properties, you're staring at spreadsheets, you're analyzing listings, doing drive-bys. Out of those 100, you only run the math and make offers on 10 of them. And out of those 10 lowball aggressive offers, you expect 9 to be outright rejected. You only expect one single offer to get accepted.
Just one.
And the quote that really stands out from a veteran investor in the material is this: if more than 1 out of 10 of your offers gets accepted, you are offering far too much money.
Yes. The rule is designed to force discipline. It entirely removes the emotional attachment from the buying process.
This is just math.
Exactly.
Mm-hmm.
You might spend weekends touring properties, writing offers, and dealing with agents who think you're wasting their time.
Oh, I bet.
But you are only pulling the trigger when the mathematical discount overwhelmingly works in your favor.
But to get those lowball offers accepted, you can't target a beautiful house with a fresh coat of paint. You have to target specific types of houses. You have to find fixable flaws that terrify the 99% of normal home buyers. And the way I visualize this strategy is basically like going to the local animal shelter and intentionally adopting the ugliest, smelliest dog you can find, specifically because you know a $20 bottle of shampoo and a haircut will turn it into a show dog.
That is a perfect analogy.
Yeah.
I love that. You are actively searching for superficial ugliness that masks structural integrity.
Let's run through the specific flaws the sources outline, because the psychology behind them is just fascinating.
Let's do it.
First on the list, a bad smell. The sources literally refer to this as the smell of money. We're talking about a house that smells intensely like wet dogs, stale cigarette smoke, or worse. It drives away almost everyone who walks through the front door.
It really does. A retail buyer walks into the entryway, gags from the odor, and immediately walks back out to their car.
They don't even look at the kitchen.
No, they cannot physically envision their family eating dinner in that environment. But an investor's brain operates differently. An investor walks in, registers the odor, and immediately calculates the remediation cost. Renting an industrial ozone machine, ripping out the saturated carpets, and spraying a fresh coat of Kiltz-Krimer over the subfloor.
So it's a known fix.
Right.
No.
It is perhaps a weekend of physical labor and a few $100s in materials, but the presence of that smell might drop the asking price of the property by tens of thousands of dollars.
It's wild how much money people will leave on the table just to avoid a bad smell.
It is.
Next up is the hidden third bedroom. You're hunting for a two-bedroom house that happens to feature a massive, awkwardly large storage room or maybe an excessively gigantic master suite.
Right.
You frame up a wall, throw up some drywall, add a standard door, and suddenly the city tax records and the rental market view it as a three-bedroom house. You've instantly boosted the fair market rent and forced the appreciation of the asset for pennies on the dollar.
Exactly. By adding that bedroom, you are altering the asset's technical classification in the eyes of the local market, drastically increasing its yield without adding any square footage.
Then there's the bad, ugly roof. Now, to the average person, a bad roof sounds like an absolute disaster. Water coming into the house is the ultimate fear.
Terrifying for most people.
But the sources argue an ugly roof is actually a massive opportunity.
It really comes down to the psychological impact a sagging or missing shingle has on a family looking for a home. A failing roof signals water damage, hidden black mold, and impending financial ruin.
So they run away.
They do. But functionally, roofing is one of the most straightforward, predictable trades in the construction industry. A reputable contractor can usually rip off the old materials and install a brand new roof in 2 or 3 days.
Wow, that fast.
Yes, it is a mathematically defined, contained fix that scares away an irrational amount of market competition.
Then we have the labyrinth. You find an older house built with a dozen tiny separated rooms, a formal dining room closed off from a tiny galley kitchen, closed off from a dark living room.
So claustrophobic.
Modern buyers hate this. They want open concept layouts. They want to stand at the kitchen island and see the television.
Of course. And identifying and removing non-load-bearing walls to open up a floor plan is another relatively straightforward process. It radically shifts the property's modern appeal, allowing you to charge premium rent.
And finally, the jungle. A front yard that looks like Tarzan set up camp there.
Oh, curb appeal is huge.
Overgrown bushes blocking the windows, dead trees leaning over the driveway, weeds up to your waist. It looks haunted from the street.
It scares people off before they even park.
But a weekend with a rented wood chipper, a chainsaw, and a landscaping crew completely transforms the curb appeal. But looking at all these examples, weeds, a bad smell, an old roof, it brings up a crucial question for anyone trying to apply this.
Okay, what's the question?
Why are buyers so irrational? Like, why does something as simple as overgrown bushes actually drive away 99% of the competition?
This raises an important question about market efficiency. We assume markets are entirely rational, but residential real estate is driven almost entirely by human emotion and a lack of spatial vision.
Emotion over logic.
Always. When a family is touring a potential home, they're trying to imagine their future life unfolding in those rooms. They need to walk in and instantly feel safe, clean, and happy.
Right.
If their very first sensory experience is the intense smell of cat urine and navigating a dark, claustrophobic hallway, their brain's amygdala immediately signals danger or disgust.
So they just react.
Yes.
Yeah.
They do not possess the technical knowledge or the desire to calculate the cost of remediation on a spreadsheet. They just want to leave the premises.
They're buying a feeling, a fantasy. They aren't buying a spreadsheet.
Precisely. And as an investor, your entire business model relies on exploiting that emotional reaction. You step into the wide gap between the retail buyer's visceral disgust and the actual mechanical cost of fixing the problem.
That is brilliant.
By intentionally hunting down these counterintuitive, deeply flawed properties, you force appreciation upon the asset. That is how you drive your cash flow and your cash-on-cash return, far beyond that standard 6% average we talked about.
Allowing you to entirely outpace the stock market.
Exactly. You are being financially compensated for bringing vision and execution to a chaotic situation.
So, if you're looking to actually pull this off, the journey is incredibly clear. We have to start by completely destroying the myth of the magical passive income bed where you sleep while getting rich.
That bed does not exist.
It really doesn't. Real estate is a gritty, customer-facing business. It requires a high tolerance for administrative friction, managing tenants, and fixing toilets.
Watch the toilets.
We learned that while seeing your property go up in value over 30 years is nice, relying on natural appreciation is just gambling. Your true north must always be positive, mathematically proven cash flow that survives the monsters of CapEx.
Absolutely.
And your ultimate weapon to secure that cash flow is to ignore the pretty turnkey houses on Zillow. You must become a disciplined hunter of the stinky, labyrinth-like, overgrown jungles that everyone else is too emotional to touch. You find the ugly dog, you scrub it down, and you rent it out.
It is a phenomenal wealth-generating system when executed with strict mathematical discipline. But, it certainly changes your perspective on what investing really entails.
It really does.
Which leaves an interesting question to consider as you look at your own portfolio, long after we wrap up here.
Okay, lay it on us.
We've established that forcing appreciation is the true key to wealth here. Hunting down failing roofs, tearing out labyrinth walls, dealing with the smell of money, and taming Tarzan-style jungles.
Right.
But if that level of physical intervention and management is what it actually takes to beat the stock market, at what point does rental property investing stop being an investment portfolio and simply become a full-time job as a construction project manager?